Imagine watching like a herd of gazelles, right? And they all cluster together for safety, entirely unaware that they are standing precisely where the lions have set their trap.
Yeah, literally right on the tripwire.
Exactly. And in the crypto markets, that trap was the $69,000 resistance level. So, welcome to the Inner Circle, everyone. If you're joining us today, you are officially part of the Bitcoin Deep Dives family, brought to you by MyCryptoParadise.
That's right. Glad to have you here.
Today's deep dive is, well, it's an analysis of a recent, just incredibly detailed strategy breakdown from Simon. And, Simon is one of the master traders over at the Paradise team.
Yeah, it's a phenomenal breakdown.
It really is. We are basically taking a masterclass in behavioral science today. We're unpacking that stark contrast between the gambling mindset, the one that causes the masses to just bleed capital, and the disciplined psychological edge of a professional trader.
Because, to really understand how to protect your capital, we have to start by deconstructing how the market actually functions.
That's right.
How it strips that capital away from people.
Right. From the undisciplined.
Exactly. And Simon uses this visceral metaphor in his analysis of the 15-minute time frame. This was right when Bitcoin was hitting that major resistance at $69,000. He describes the market not as like a random number generator, but as a predator.
A predator?
Yeah, it hunts. And specifically, in this instance, it was hunting the exact areas where retail traders had hidden their stop-loss liquidations.
Okay, so let's look under the hood of that trap, because this is fascinating. As humans, we are biologically wired for herd mentality, We seek safety in numbers.
Absolutely. It's survival instinct.
Right. So if a retail trader sees a massive psychological barrier like $69,000, they look at their chart and decide, hey, I'm going to put my stop loss just below it, say it's $68,900.
Because it feels logical.
Yeah. It feels like putting a safety net right below the tightrope. But you're saying that behavior is exactly what gets them killed.
Oh, 100%. When thousands of novice traders cluster their safety nets in the exact same obvious zone, they aren't building a fortress. They are creating this massive pool of liquidity.
And the market loves liquidity.
It is physically designed to gravitate toward it. To understand why, you have to look at the mechanics of institutional trading. If a massive institutional player, the predator in this scenario, wants to enter a gigantic buy position, they can't just open their app and click buy.
Right, because of the sheer size of the order.
Exactly. If they do that, their massive order will just eat through all the available sell orders on the books, driving the price up exponentially before their order is even fully filled.
So they end up buying at terrible prices.
Right. This is called slippage, and it costs them millions.
I see. So if the market is a predator, does that mean every retail trader is just inevitable prey? Is it like a casino where the house always wins, or is it more like a jungle where you just need to learn how to track the tiger?
It's definitely the jungle. You just have to track the tiger. Because the tiger, the institution, needs an opposing force. To buy a massive amount of Bitcoin without moving the price, they need a massive amount of people selling Bitcoin at the exact same moment.
Ah. And where do they find a massive guaranteed cluster of sell orders?
In the retail stop-loss pools. Because, think about it, a stop-loss is simply an automatic trigger to sell at market price.
Right, it's an automated panic button.
Basically. So the predator engineers a slight price drop. They push the market down just enough to trigger that cluster at $68,900.
And boom.
Boom. Suddenly, thousands of retail stop losses trigger simultaneously, flooding the market with sell orders. The institution absorbs all that liquidity, filling their massive bags at a massive discount, and then the price just immediately reverses upward.
Leaving the retail trader completely wrecked.
Wrecked, and wondering what happened. Their capital is absorbed. And this is what Simon means by the gambling mindset. You're placing your capital based on what feels safe to the herd, rather than actually calculating the mechanics of the order book.
But wait, let me play devil's advocate here. If everyone knows $69,000 is an obvious resistance zone, wouldn't the big institutional predators just sell there too? Like, why bother engineering a drop just to hunt retail stop losses if the whole market is already expecting a rejection at that level?
That is a great question. It's because institutional players operate on a completely different time frame and scale. They aren't trying to scalp a quick profit at a local resistance. They're accumulating for macro moves.
Okay, so they're thinking way bigger.
Way bigger. If they want to build a position for a push to 80,000 or 90,000, they need to accumulate massive volume at 68 or 69,000 without tipping their hand. And the only way to accumulate that much volume at the top of a range without causing a breakout before they are ready is to induce forced selling. They use the herd's fear against them. They shake the tree, cash the apples, and then let the trend resume.
Wow. That completely reframes the idea of a stop loss. It's not a safety net. It's literally a target painted on your back if you put it where everyone else does.
Exactly.
And, this herd mentality doesn't just happen in a vacuum. Chart traps rely heavily on psychological triggers to force traders into making mistakes. The trap is often sprung by external noise.
Oh, the noise is the worst part.
Which brings us to a perfect example of outside noise intercepting with panic bias, because it's not just price action that triggers the herd.
No, not at all. And Simon's breakdown highlighted a very specific instance of this recently. We saw this massive spike in geopolitical noise. Specifically, there was a quote from Donald Trump warning that, I'll just quote it directly here, a whole civilization will die tonight.
Okay, let's just pause right here and establish our baseline for a second. We are strictly impartial. Our focus today has absolutely nothing to do with endorsing or condemning or commenting on the politics of that figure or the context of that specific statement. We are acting entirely as data scientists here.
Just looking at the charts.
Right. Our only mission is to analyze the objective, factual reaction of the cryptocurrency market order books to that specific headline when it hit the news feeds.
And looking purely at the behavioral economics of it. Statements that carry that level of existential threat, they act as massive psychological shockwaves in the market.
Yeah, it triggers immediate emotional reactivity.
Exactly. When the amateur trader reads a headline about civilizations dying, their amygdala, which is the fear center of the brain, literally hijacks their prefrontal cortex.
The logic centers just completely shut down.
They go totally offline. The strategy they spent hours backtesting, forgotten. They open their exchange app and just smash the sell button to get into cash. It is pure biological fight or flight translated into financial action.
Right. So the gambler reacts to the headline, but the professional reads the momentum underlying that panic. Because while the herd was panic selling in response to that geopolitical noise, Simon and the Paradise team were calmly looking at the data.
They didn't even flinch.
Right. And they identified what they call a bullish exaggerated divergence. So what does that actually look like under the hood?
So it's a divergence between the price action and the actual momentum of the volume. On the surface, if you just looked at the chart, the price of Bitcoin was making lower lows. The chart looked bloody.
Which just validates all the fear the retail trader is feeling.
Exactly. But under the hood, the momentum indicators like the MACD were making higher lows, which means the velocity of the downward movement was fundamentally decaying.
The sell-in pressure was basically exhausting itself.
Exactly. The panic sellers were simply running out of assets to dump into the order book. The herd was running off a cliff, but the professional could see, just by looking at the data, that they were completely out of breath.
Man, that is the MyCryptoParadise difference right there. It's the ability to decouple your emotional state from the flashing red numbers on a screen.
It takes a lot of discipline.
It does. And, looking at an indicator like the MACD and seeing momentum fade, that can feel very abstract for a lot of people. How does a professional trader translate all this complex mathematical data into an actionable strategy without just getting paralyzed by analysis?
Well, they rely on simplified mental models. A master trader doesn't try to compute every single variable, right? They use structural analogies to recognize patterns in all that chaos.
Right, because otherwise it's just noise.
Exactly. So Simon frames the entire market as a breathing organism. It cannot simply run upward forever. It has to inhale and exhale.
An impulsive push upward is the inhale, bringing oxygen into the system.
You got it. And a downward correction is the exhale. In his breakdown, he notes the market is currently in a complex bearish formation called a double three.
Okay, which means what, mechanically speaking?
Mechanically, a double three is a prolonged sideways to downward corrective phase. Basically, the market is taking a very long, drawn-out exhale.
Just slowly letting the air out.
Yeah, it is burning off excess leverage and exhausting the buyers who bought the top. But Simon pairs this with another, even more specific analogy to explain the MACD momentum indicator. He calls it the push-up analogy.
Oh, I love this one. Let's walk through that because it brilliantly illustrates order book exhaustion.
Yeah, it's great. Yeah. So imagine the buyers, the bulls are down on the floor doing push-ups. They blast through the first 50 push-ups. They have massive capital. They're absorbing all the sell orders, and they're driving the price up effortlessly.
Just pumping them out.
Right. But then they go for push-ups 51, 52, 53. The arms start shaking, the form completely breaks down.
Exactly. The bulls are still pushing the price upward, but it requires agonizing effort. They're running out of capital to absorb the incoming sell orders at those higher prices, and eventually, gravity takes over.
And gravity in this model is the sellers, right? The bears. Yes, the bears are gravity. The bulls exhaust themselves, their momentum drops to zero, and gravity just pulls the price down. On a technical chart, this moment of ultimate exhaustion triggers what we call a bearish cross on the momentum indicator.
And it leaves a visual footprint on the chart, right? Like Simon pointed out a specific candlestick pattern that forms when gravity wins, the double shooting star.
Yes, the double shooting star.
Let's break down the physical anatomy of a shooting star candle. Because it has this tiny body at the bottom and a very long wick stretching upward. Why does it look like that?
Well, think of a single candlestick as a localized battle map for a specific time frame, like, say, one day. The long upper wick represents the bulls trying one last desperate push-up.
They drove the price high during that day, trying to just force the rally to continue.
Right, but sitting up there at those higher prices was a massive wall of institutional sell orders. So the sellers slammed the price all the way back down to where it started before the day closed. Yeah, the wick is essentially the visual record of a failed offensive. When you see two of those in a row, a double shooting star paired with a bearish cross on the Man CD, it is the market screaming that the buyers are entirely out of capital.
Okay, so let me challenge the application of this.
Sure, go for it.
If Simon sees the double shooting star and he sees the bearish cross and he knows the bulls are trembling and gravity is inevitably taking over, why not instantly open a massive short position? If all the models point to exhaustion, why doesn't a professional just aggressively bet the house on the drop right then and there?
Because taking a position based on a single signal, even a really strong one, is a gamble. The professional trader demands confirmation.
They need more proof.
Always. Simon's breakdown specifically warns against acting prematurely. A bearish cross on a daily chart might look terrifying, but if it isn't confirmed by the weekly time frame, or if the price hasn't actually broken below a key structural support level with high trading volume, the setup is incomplete.
Because the market is infamous for fake-outs, right?
Oh, absolutely infamous. The bulls could suddenly find a second wind, or maybe a new player enters the market with fresh capital. If you shorted aggressively at the first sign of trembling arms, that second wind will liquidate you.
You're just gambling on the first sign of weakness.
Right. The professional builds a case using multiple overlapping time frames and indicators. They wait for the structure of the market to officially break before they commit any capital.
It is the discipline of layering evidence.
Perfectly said.
And that discipline requires zooming out beyond the charts entirely. Because this exhaustion we're talking about, it isn't just happening to retail traders clicking buttons on an app. It's happening in the physical world, to the massive industrial operations that actually secure the Bitcoin network.
Yeah, we have to talk about the miners.
We do. This is where macro reality just crashes into technical analysis.
Which is such a core part of the MyCryptoParadise philosophy. It requires understanding the global business environment, not just staring at 15-minute candles all day.
Right. And Simon's analysis highlights this severe capitulation event that is currently underway among Bitcoin miners.
It's brutal out there for them right now.
It really is. The data shows that Riot Platforms, which is one of the largest publicly traded mining companies in the world, recently moved 500 Bitcoins onto a public exchange. And they have been systematically selling off their Bitcoin reserves at a loss for over a month.
To really understand the weight of that, we have to look at the business model of a Bitcoin miner. A mining operation is essentially a massive, energy-intensive factory.
Right. They have massive capital expenditures, like buying the ASIC mining rigs.
Exactly. And brutal operating expenses, primarily electricity and cooling. They produce a product, which is Bitcoin. But right now, the global macro environment is just hostile.
We're seeing trade wars disrupting supply chains for hardware.
And we're seeing global energy crises causing electricity costs to absolutely skyrocket. Their assembly line costs are doubling, while the market price of the product they're producing is dropping.
So they're getting violently squeezed.
Violently. They're bleeding cash.
So when Riot Platforms moves 500 Bitcoin to an exchange, they aren't doing it because they got spooked by a geopolitical headline on Twitter.
No, not at all. They are selling to survive. They're liquidating their treasury just to cover their skyrocketing operating expenses and to service their debt. It's a forced liquidation.
They have no choice.
None. And this macro pressure creates one of the most important phenomenons in all of investing. It is what we call the exchange of hands.
Let's deeply unpack this concept because understanding the exchange of hands it's the key to identifying generational wealth opportunities.
It really is. Market bottoms, the absolute highest probability zones to accumulate an asset, are forged in the fires of capitulation. It happens when an asset is forcefully transferred from weak hands to strong hands.
And in a brutal bear market, who are the weak hands?
The weak hands are anyone forced to sell, regardless of price. Right now, the miners are the weak hands. They have to sell at a loss just to keep the lights on in their facilities. Retail traders who over-leveraged are also weak hands because they're forced to sell via margin calls.
But someone is on the other side of that order book.
Exactly. Someone is buying those 500 Bitcoins from Riot Platforms.
And those are the strong hands, the institutional smart money, the players with abundant capital reserves who have just been sitting in cash waiting for the market to bleed out.
Precisely. And Simon's analysis maps out a critical geographical zone for this transfer of wealth. He's looking at the territory between $44,000 and $55,000.
Okay, so that 10 range is the target.
Right. Based on historical data, network profitability metrics, structural support, he identifies this as the high probability zone, where minor capitulation will reach its absolute peak. The weak hands will dump their final reserves, and the strong hands will step in to absorb that massive supply shock.
Establishing the ultimate floor. The psychological contrast here is staggering, really. The amateur trader, the gambler, sees the price plunging toward $50,000 and they try to play hero.
Oh yeah, they try to catch a falling knife.
Right. They guess where the exact bottom is, they buy in way too early, and then they get stopped out and lose their capital when the price violently flushes another 10% to clear out the leverage.
Because they act on impatience and ego.
Exactly. While Simon has a plan A, his strategy is entirely centered on patiently waiting for this massive macro transfer of wealth to actually materialize.
He is literally just watching the miners capitulate.
Yeah.
He is watching the retail herd get hunted by the predator, and he is letting the structure break down entirely before he initiates his aggressive reaccumulation phase.
Which brings us to what might be, honestly, the most difficult skill in trading. The zen of capital protection, the ability to just sit there and watch the chaos unfold without participating.
It's so hard for most people.
It is. In the breakdown, we saw a glimpse of Simon's recent tactical activity for the MyCryptoParadise VIPs. He executed a strategic 17% profit on an altcoin short using a heavily calculated 3x leverage.
Right, it's a very surgical, isolated strike.
But beyond that, he is completely refusing to experience FOMO.
No fear of missing out whatsoever.
None. He refuses to jump into a long position just because the price of Bitcoin ticked up for a few hours on a Tuesday.
Because he operates on an unbreakable core rule. Until a macro resistance level is broken, and then retested and confirmed as new support with verifiable institutional trading volume, the overarching trend is bearish.
And you do not argue with a bearish trend.
You do not try to outsmart gravity.
Simon made a statement in his strategy breakdown that I think just distills the entire professional mindset. He said, sometimes doing nothing is the highest probability position you can take.
That is so profound.
Yeah.
Because in the financial markets, holding cash or stablecoins is not an absence of a position.
Right.
It is an active defensive position. Choosing to deny the market your capital when the probabilities are low is the absolute hallmark of a master.
But it violates our fundamental human psychology. We suffer from a severe action bias. If you're sitting at your desk, analyzing charts, staring at flashing numbers, your brain tells you that you must be doing something to be making progress.
You feel this overwhelming urge to click buy or click sell just to feel productive.
Yes. If you are just watching, you feel like you're failing.
But that is simply the dopamine receptors begging for stimulation. The gambler requires the emotional thrill of being in a trade, even a bad one.
They just want to play the game.
Exactly. The professional, on the other hand, has mastered the discipline of boredom. They cultivate the ability to sit on their hands, waiting days, weeks, or even months for the technical indicators, the macro environment, and the underlying momentum to all align perfectly.
Because until the market presents a high probability setup, protecting the capital you have already amassed is the single most profitable action you can take.
100%.
So, as we wrap up this deep dive, let's just crystallize the journey we've taken today. We've deconstructed how the market operates as a highly efficient predator, utilizing institutional order flow to hunt the liquidity pools created by retail herd mentality.
Yep, the trap at 69K.
Exactly. We've analyzed how external noise, like geopolitical headlines, triggers the amygdala, causing the masses to panic sell, while professionals quietly measure the decay of momentum.
Seeing that bullish, exaggerated divergence.
Right. And we've explored the structural anatomy of the market through the lens of a breathing organism, where bulls exhaust their capital doing push-ups against the gravity of cell walls, leaving behind the visual evidence of long candlestick
A
wicks.
double shooting star. And then, of course, we zoomed out to the macro pressures crushing the mining industry.
Right, forcing that massive exchange of wealth from the weak hands of over-leveraged factories to the strong hands of patient capital in the mid-$40,000 zone.
The dichotomy is undeniable. The gambler trades on hope, they trade on fear, and they trade on the adrenaline of the next headline.
While the professional trader, utilizing the methods we see at MyCryptoParadise, they trade on probabilities, structural mechanics, and just infinite patience.
They wait for the predator to exhaust itself. They understand that preserving capital is the prerequisite to multiplying it.
It requires a complete fundamental rewiring of how you perceive risk, reward, and your own internal biases.
It truly does.
And that brings me to a final provocative thought I want you to take away from this breakdown. In his approach to the markets, Simon treats his losses, his stopped-out trades, and his missed opportunities not as personal failures, but purely as data.
Right, it's just clinical feedback used to recalibrate his system.
Exactly. He has entirely divorced his ego from the outcome. So I want you to think about your own life. If you applied that exact same unemotional, analytical framework, viewing your personal setbacks purely as data points, refusing to react impulsively to outside noise, and patiently waiting on the sidelines for your absolute highest probability moment to the biggest challenges in your life outside of the crypto markets,
Man.
what would your next move actually be? Stripping the emotion from our biggest decisions really changes the entire landscape.
It's something to deeply consider. Thank you for joining us in the Inner Circle today. Remember to analyze the data, protect your capital, and trust the process. We will see you on the next deep dive.